Well, we had our first federal interest rate cut in months, and now to give us a look at where we stand, we welcome Chuck Zodda from the Armstrong Advisory Group. And Chuck, thanks so much for being back with us. And first off, we saw a 0.25% rate cut. What impact do you see this having on the economy?
Quite honestly, very minimal. And the reason why is twofold. The first is that the market had largely been pricing this cut in, and so mostly it was expected. There isn't anything that dramatically changes after it. The second piece is that in order to actually see, the kind of important drivers of economic activity move in a favorable direction. Think mortgage rates coming down, auto loan rates coming down, things along those lines. You typically need larger moves in the federal funds rate, which is a short-term interest rate, in order for those longer ones to potentially have room to move down further. So a 0.25% cut or even a 0.25% hike in the opposite direction doesn't really make a huge difference. It's going to be the question of, hey, is there continued travel in that direction? And if there is, it's that continued travel that then starts to make it more affordable for borrowing potentially. Because right now, the interesting thing that we've seen since that rate cut last Wednesday, we've actually seen mortgage rates tick up almost 0.25%. And so, even though the Fed cut very short term rates, longer term ones have been moving in the other direction. And so, you have to pay attention to this when you're trying to figure out what the net effect is on the economy.
Do you see the Federal Reserve cutting the rate again this year? And if so, why?
I do think they're very likely to. And the reason why is there are continuing signs that the labor market is not in a great spot. And historically, the way that the Fed deals with labor market weakness is through cutting interest rates in order to stimulate demand. And then that additional demand spurs companies to hire in order to fulfill the demand. So I do think it's likely that we see additional rate cuts. The magnitude of them, how long they continue for, I think is an open question. But I think that there's a pretty good chance that we see more cuts as long as we're not seeing a further ramp up in inflation that starts to concern the Fed as well.
Next up for the Fed is the Personal Consumption Expenditures Index, which gauges inflation on Friday. What are your expectations there?
So the market is expecting a month over month rise of 0.2% on the headline number, 0.3% on core, excluding food and energy. And so if you come in that range, it still is elevated. Remember, a 0.3% month over month number equates to about a 3.5% annual inflation rate, which is pretty hot. But ultimately, the Fed has gone on record in a lot of cases, or at least members of the Fed have gone on record, saying that they do think that some of the inflation that we're seeing may be short term and transitory because of tariffs and may not present a longer term threat to the economy. So it's kind of a leap of faith that the Fed is making here, where if they're right, then this could all play out very well for them. But there is still a risk that inflation may inflect higher. And that's one that we have to watch over the coming months to see if it becomes a real issue.
There's been a lot of rough headlines, Chuck, obviously, in the headlines or in the world lately, in our country. And at times it feels like the country itself is really on its heels and divisive. How much does people's happiness play into the outcome of our economy?
It's a good question. And I think I'll take it in two different pieces. In the short term, I don't think it affects it very much, simply because ultimately we all have bills that we need to pay each and every month, and we have to work the jobs that we're working in order to pay those bills. So I think in the short term, it's not something that's a huge driver. In the longer term, I'm not so much looking at happiness, but I guess when we talk about just the feeling of overall safety and security, I think is a hugely motivating factor to be able to go out and actually take risk. Because ultimately, there are really two ways that people take meaningful risk in their lives. It's either because they feel that they have enough support and enough comfort to be able to do so, or because they get so desperate that they feel that they have to. And obviously, you want more of the former and less of the latter. So I think, as I look at the overall landscape, I think one of the questions is, hey, if the feeling of safety and security erodes within the United States, I do think that that's something that potentially has longer term impacts on risk taking and things along those lines. But that's something that I don't think is going to have any kind of meaningful short term impact, simply because ultimately We have to get up and do what we need to do in order to feed our families, keep roofs over our head. And that's stuff that doesn't really change in the short term. So I don't think there's much that we're going to see in terms of any differences in the economy as a result of that right now. But it's something where if you look out 10, 20, 30 years, maybe that's something that you start to see, if we see continued, trends in this direction. But it's pure speculation. And unfortunately, I don't know that we're going to be able to have a great way to measure this in the interim. I think it's going to be something that you really need to look longer term at. And, when we get out to 2055, I'm sure we can have great conversations about, hey, remember when we talked about this, but it's going to be a while before we know.
All right. Well, Chuck Zodda of the Armstrong Advisory Group, thank you so much for the time as always.
All right. Have a great day.